Good morning, everyone. So, half an hour here. I'm going to present for a bit, not on the individual commodities. We can take questions on that in the Q&A, but just about some of the thematics that we have to think about as we head into 2024. Really interesting time for global commodity markets. A lot of moving parts as ever. We're just going to discuss what we might see. BMO, just very quickly, I mean, most of you know us, we're big in metals and mining. That's what we do globally. Just one flag, if you want, we do a Metal Matters podcast every second week. It's available on your podcast provider of choice. The good advantage of that is you can listen to me without seeing my face. So that is always a better way to look at it. Let's start with just the basics here. Now, people ask me, how are you feeling about things at the moment? I'm concerned about geopolitics. I am concerned about financial markets. I think a lot could go wrong there. The actual economic cycle is okay. Look here at the OECD leading indicators. You can see in all the major regions, they're positive. And that's the first time we've seen that since 2021. So for all the concerns about a slowdown, and we've seen, things like, we've seen some of the inflationary pressures ease, and we'll talk about that in a minute. But has been a lot of resilience in the wider economic cycle. Global industrial production has remained positive, and we actually see it picking up a little into next year. We're looking at 1.4% global industrial production growth. It's hardly stellar, but it's better than we saw this year, where we're looking at kind of somewhere between 0.9 and 1. And that's not building in any sort of restock. It is basically saying, well, we still keep inventories low. If we do get rate cuts coming through in the second half of next year, which is a BMO economics forecast, we may start to see more of a restock come through. One other thing I wanted to flag for all the concerns about China, China still leads the way in terms of growth. It is the world's largest industrial economy. It is still crucial for many of the commodities that we will be looking at this event. Where's inflation gone? That's another question we get a lot at the moment, because we've never seen a period in the post-war era where advanced economies have seen inflation fall without a recession. Supply chain's a big part of it. Now, of course, this is the New York Fed Supply Chain Pressure Index on the left-hand side. We basically were at a record high 2 years ago, and we've now gone to a record low. In fact, the November figure is even lower again when that was printed last week. So the pressure in supply chains really has gone. Now, for the mining industry, this should mean costs start to fall. We should be starting to see costs ease, and goods price inflation is totally gone at the moment. Now, for those of you who saw me present this at LME Week, we looked at the energy prices since the middle of the year. Actually, those energy prices have also started to ease. You've still got LNG high, you've still got uranium strong, oil back at $75 a barrel. Well, again, that goods pressure is coming out. So we have seen this supply chain pressure ease. It means lower metal premiums in certain cases, but it does mean that some of that inflationary pressure that crimps demand is actually starting to ease. Let's talk about China. If you were just reading Bloomberg News, you'd thought it was a horrendous year for the Chinese economy. And yet, if you look at all those metrics, they're pretty much positive with one major exception, and that's real estate. China property, there's still a number of challenges. I will talk about that a little bit later on. But everything except property is doing pretty well. And particularly some of these energy transition related areas, which again, we'll talk about a little bit later. The fixed asset investment in things like electricity and heat up 25% year on year. So everything except real estate is doing okay. And I would say China's sentiment hit a nadir around June, July. And since then, it's been pretty clear what the government there is doing. They are supporting the economy. It's not big bazooka stimulus. It is small, incremental, piecemeal bits of fiscal support. And that path is pretty clear. That path will continue into 2024. Let's look at that right-hand side there. Let's look at change in Chinese demand for metals. 2023 has been a much, much better year than 2022 for this. We've actually seen pretty strong growth across everything ex steel. So China demand has been absolutely fine. Can we offset a slowdown in China property with other areas? The past 2 years have proven that that's happened already in the Chinese economy. There are naturally questions as to how that might continue, But for now, China's not the demand problem here. Ex-China is. If just looking at left-hand chart, the kind of blue squares are where we're seeing ex-China demand growth for the key base metals there. Nickel is a bit of a story on its own. That's helped by the battery side. But if we look at aluminium, copper, zinc, you can see subtrend, down year on year. This is what inflation does do to advanced economies. And you have seen some of that inflationary pressure way on demand, and ex-China's really taken the hit in terms of demand growth. We do see a slight improvement over through to 2030. This is, of course, some of the global thematics now, not just the one-speed China engine. But at present, we're still sub-trend ex-China. That has been the problem. Now, with everything, there's exceptions to the rule, and that exception ex-China is India. India's that economy we've talked about with a lot of potential for years, and potential means it's not happening now. Well, actually, if we look over the past 18 months, India's been the strongest economy for metals demand growth in the world. It's amazing what you can do if you get money in the banks. So basically the banning of cash, or the de facto banning of cash, getting money in the banks, allowing the banks to lend money, having a little bit more stability, if you want, in the government system. We've finally started to see quite a lot of growth coming through. My old metric was you always take what the Indian government say it's going to do, and you half the growth rate, you get to about the right number. Well, actually now I can think there's a bit more confidence coming through that India is going to be a player, and you do now start to see a lot of the producers out there look towards India and put their sales and marketing teams in there for the next incremental unit. Coming to the supply side, mining capex. It's improving. That's if you want, that's the good news for many in the room. The bad news of that is that a lot of that's just the inflationary pressures itself. We do have labour pressures, we have contractor pressures across the world. So on a like-for-like basis, it's up about 5%, we think, on a year-on-year basis. It's never been harder to build or permit a mine. You're hearing that a lot at the company presentations here. There is a little bit more acceptance that growth will be needed, but actually committing to that growth is hard, particularly as the price prompts aren't there. So even with good Chinese demand, if we look at that right-hand side, you look at where spot prices are relative to a year ago, which is the blue bar, and relative to our long-run prices. And in most cases, they're down. So the markets are not giving the signal to go and approve projects, to go and add new supply. And that's a challenge. It takes, therefore, either different sources of funding, a little bit more risk. But sadly, we do have a world where returns have to be short-term. You can take a risk in a mining project that may or may not return capital in 10 years' time. Or if you're a larger company, you can pay shareholders back this quarter and be rewarded for it. And I still think we're in the stage of the cycle where many of the larger asset management firms are still rewarding companies for returning capital rather than building growth projects. That has not changed yet. And where prices where they are is not going to encourage that. So what happens if we don't get supply? I mean, we are looking more and more at how we're having to adjust the demand side of the equation. Because if you model a lot of these commodities on an unconstrained basis, you run into problems. And we simply can't solve the shortfalls we're likely to see with supply alone. We are building in things like greater recycling. Scrap is suddenly hugely strategic in global markets. It is the one thing, of course, I've said it before, I'll say it again, that the developed world is naturally long of. And we are starting to see greater efforts put in place for higher recovery rates. I was just reading an article today about secondary aluminium capacity in China. 8 million tons of capacity being added over the next 24 months. But then, if even with scrap and with, generous projections on mine supply coming through, you can't solve the balance, well, you need to look at things like thrifting and substitution. Demand side adjusts. Commodity markets will always adjust and will always come to balance. And the smart thing is to think about how they're going to do that. The big deficits you might see projected, they simply aren't going to happen. So let's talk about substitution and thrifting. I put up the example of copper here on the left-hand side from some of the work we've done in this area. If you can't, as I say, if you don't have the supply, you will look to an alternative. Substitution is, of course, using a different metal. For copper, that is normally aluminium. And you see we're seeing a bit more of that in things like commercial air conditioners, where you're not space constrained to a certain extent. But then you look at the left-hand side and the y-axis, if you want, and that's thrifting, designing stuff out. And I think you are starting to see a lot of the end users of materials looking at adjusting what their needs. I'm going to very flippantly here. I mean, if you're a purchasing manager at the moment and you've been told all year that we're going to run out of copper by the end of the year by some of the big trading houses and some of the banks, if you're not looking at an alternative, you're probably not doing your job. So we are starting to see signs of thrifting and designing out coming through. You can see there we put up electric vehicles. This is actually natural. It's bad for the thematic. It's bad for how generalist investors think about the wider energy transition. But of course, the first electric vehicles were proof of concept. They were naturally over-engineered. They had to work. Now, the auto industry is great at actually reducing usage, so designing stuff out. So we are starting to see a lot more thrifting. You will see more of that. But it does mean that your battery electric vehicle being 4 times more copper intensive is now coming to 3 and will probably go lower. That's not something to be scared of. That's just a natural way that the markets tend to work. Let's move on to something different. Let's talk about geopolitics. I presented this slide before, but I mean, I still think it's pretty valid. We are moving to a world where we're getting segmentation of value chains. And that's important. I mean, we're particularly in terms of who has the raw materials. Security of raw material supply is now a major geopolitical concern as of the past 18 months. That is a re-rating for all the companies involved in that sector, but it does need a lot of sorting out. So you see on the left-hand side there, we have, in terms of the proportion of commodity supply from the developed world, from China and Russia. So if you want the old Eastern Bloc, as we used to model it back in the pre-Berlin Wall days, or in the fall of the Berlin Wall. And then you've got this middle ground, which is the battleground. And you're starting to see a lot of efforts made by governments to woo other nations and form their own little packs. And we're still in the early innings of this. There's a lot more to go on, but it does mean we're probably looking a little bit more towards government capital in certain areas. How do you, though, solve the problem that, I mean, in many cases, that Chinese supply is a lot cheaper and is winning the economic battle? Well, I am a believer that we move towards things like responsible sourcing. You move towards a qualification rather than a premium. This is not a new thing. I mean, if you think of companies looking for ISO 9001 or 14001 certification, that's an inherent part of many value chains. And I think we'll move towards that in the mining side as well. It will take a while, but you will probably move towards a situation where you have material that has a third-party audited stamp on it that says it's low carbon. It is adding value to communities where it's extracted. It is, it is traceable through the value chain. And this is how if you want, that qualification process will feed through, and it will lead to equity re-rating in time. Talked about scrap before. One interesting trend we're seeing, this is aluminium. You can see that scrap exports have fallen quite sharply this year. You're going to see resource nationalism around scrap, so we will have less scrap exports from the developed world. That means that a lot of the other emerging markets, like the Indias of the world who are trying to grow, will need a lot more virgin raw material to come through. Also, just put up on the right-hand side there, we might see a little bit more support coming through for smelter capacity. If you look at there, that's the China plus Russia share of output. Getting 50% or above in many cases. It's easier for governments to talk about funding process facilities than it is to fund mining still at the present time. Now, China knows this is coming. What we've started to see is a big ramp up in output growth from China. Partly that's to keep just to help the wider economy keep going, but we've seen record additions to copper output this year. We've obviously seen, I've put up some of the battery raw materials there, lithium and lithium iron phosphate cathode, and you can see strong growth still coming through. China's still gaining market share in a lot of areas, and on the mining side as well. I did want to flag that we are seeing fixed asset investment in non-ferrous mining pick up quite sharply this year, the fastest growth rate since I think 2007. So it does show that China is aware of these security of supply concerns in this battle for raw materials and is investing a little bit harder in its domestic economy. Coming on to critical minerals then. As I said here, it's a problem with China and a problem for China. We focus a lot about China's dominance of refined value chains. And it will take a long time to alleviate that. Now, that also ignores some of the vulnerabilities further upstream. If you look here, and this is 2022, it's changed a lot in 2023, but if you look at China's ore imports, China has a lot of high dependencies there. So there's a lot of vulnerabilities upstream there as we go into more battles. So this segmentation process, as I say, a lot more still to come through, but you are starting to see Chinese firms look overseas again to try and again secure strategic assets and play a wider role in this battle for raw materials. So it's not like China's happily going to cede its dominant position in many value chains. And I mean, we have seen, in order to fund that stronger refined output growth, you've seen a lot of Chinese raw material imports have been particularly strong this year. Coal is a bit of an exception. I mean, and that's again to try and buffer against any energy shocks. But you can see we've seen very strong growth in many of the main raw materials this year. We expect that to continue in terms of China's import volumes into next year. Just on China, I mean, I think the big change here we often think about, I mean, those of you like me who have been 20 years in this business would think about all we had to care about was China property. That was the be all and end all. Now, a couple of things I'd flag here. China property peaked 10 years ago in my numbers. This is not a new thing. If you take the total construction number from the NBS that they publish every quarter, well, basically we're only just about back at levels we were kind of 2013, 2014. So we will continue to see pressure on developers in China. They will never be what they were. They're unwinding, they're deleveraging, and it does mean you're going to see the developers offset with a little bit more government spending, local government spending on things like social housing. So the makeup of the property sector is changing. You're seeing completions of commercial properties or conversions to public housing. The big change, though, I mean, I think this right-hand chart is really interesting. That's the net increase in medium to long-term loans. So basically what the banks are putting out there. And if we look 2 or 3 years ago, but the same amount went to businesses as went to households. And households is effectively mortgages. That's the way to think about it. You've seen that household side fall away dramatically, but you've seen the business side ramp up aggressively. Seeing a lot of medium to long-term loans into the manufacturing sector. China's spending a lot of capex on process capacity, and that will continue. And that is a metal-intensive spend. Now, it's also not just in China. You're starting to see a lot more outbound investment. I said it probably won't reach $200 billion this year, but it might well get there next year. Starting to see China set up plants in ASEAN, partly you could argue to get around maybe some of the trade restrictions, but also because it just helps where China has the technological lead and the economic lead, well, which is a lot of the energy transition, then helps China maintain that market share. The longer term target, so energy transition is interesting. I mean, the number of incomings I've had over the past 6 weeks telling me the energy transition is over is amazing. Really is. That is the view of the generalist US investor at the present time, because Tesla's selling less cars and GM are lowering the sales targets and European renewable firms are going bust. The actual underlying trends are still very strong. I say to them, well, BYD's just sold the biggest number of, just sold 300,000 cars, 300,000 electric vehicles. No company's done that before. BYD is bigger than Tesla now. China's installed 200 gigawatts of wind plus solar this year. That's a ridiculous number. That is basically double what the US is planning to install in the next 5 years. So you're seeing, I mean, the real trends are still strong and China's leading them. What metals do we need? pretty much all of them in different forms. The fuel to materials transition, which is, I think, a better way to think about it, is taking incumbents and replacing them with more metal-intensive products, whether that is more copper cabling needed for renewable energy, whether it's, of course, just generally more materials needed for electric vehicles. It is a strong thing. Now, one interesting one I wanted to flag there, aluminium. I think it's forgotten a little bit, but it's these solar panels are basically built in aluminium frames. But copper, nickel, still going to be, I mean, the energy transition will dominate the growth over the coming years. And what you're starting to see, as I say, where we haven't maybe, we're starting to see US and Europe numbers maybe lowered down a little bit for the longer term. You're seeing China and the global south numbers, if you want, pushed higher because China's starting to export a lot of finished products now. China's now the largest vehicle exporter in the world, right-hand chart, and you see a lot of that is electric vehicles. We're still seeing a lot of solar panel exports coming through. You are seeing a developed world response, but it's pretty slow. The left-hand chart just looks like US manufacturing construction growth. You can see it's picked up strongly. The Inflation Reduction Act has played a part in that. You're seeing a lot of this push for reshoring. That will continue. And you will see, a lot of capital deployed that way over the coming years. What I would say, though, is going up in the right-hand side is just looking at that split by product. 3% of it's going to raw materials at the current time. There is still a bit of a view out there that the market will provide, that we will throw money at the problem and the market will solve for us. I think that's a little bit false in metals and mining, where it does take such a long time to get a capital-led response to any supply problem, and hence we will continue to run into raw material constraints. I'll leave a few times for questions. I think we're at a number of important points of inflection and growth. I'm not going to talk about these, but it is interesting that governments are starting to support mining for the first time, and it's still not coherent, but you are starting to see a recognition that this battle for strategic battle for raw materials will continue on for a while. We've had the headwinds from inflation. That is certainly going away, and it does mean that rates will likely be cut into next year. And while we focus a lot on electric vehicles and renewable energy, there's a whole lot of other metal-intensive areas on that right-hand side that I think you will be seeing decent growth coming from over the coming years. I'm going to leave our standard commodity comparison chart just to explain this. The x-axis is the potential for longer-term shortage. The y-axis is the potential for shorter-term constraints. So it's a little bit nearer term. The x-axis is longer term. And it just shows where we see various metals at the current time. With that, I'll stop, and I've got a little bit of time for some questions.
To steel demand and output, and without any obvious supply problems that we've had over the last few years, are you surprised the iron ore price is where it is?
So it's interesting. Am I surprised the iron ore price where it is? Yes, I'm going to be honest. If you'd asked me 3 months ago, would I have expected iron ore here? I'd have said, no, it's probably going to be a bit lower. But we've had very strong Chinese steel output. You've had very strong Chinese steel exports, and I have had to up my numbers for China steel exports because of the investment you're starting to see in other countries based on Chinese products. The iron ore market's a lovely market. It's a very efficient market. Price allocates resource on a short-term basis. The majors are still controlling it like an oligopoly and are doing pretty well.
It's very efficient. I mean, if you look at price versus cost of production, it's one of the great classical economists would say it's mad.
Yep.
So it's a very efficient oligopoly.
And the big test of that will come with something like Simandou or the centralized Chinese iron ore buyer becoming more aggressive in stance.
Of the two transition metals you highlighted, nickel and copper, I mean, copper has been pretty resilient, really. It's come down a bit, but it's been pretty... nickel has not. It's been quite disappointing. Why do you think nickel has been so disappointing, and how do you see that changing? Well, how do you see both of them changing from here, actually?
I mean, of course, nickel is such a complex market. You've got all these sub-markets. I mean, effectively, Class 2 nickel price hasn't really done very much all year. So we're coming from a situation where you had a bifurcated market, and we now have enough fungibility that we can close that gap. And you're starting to see what was an invisible Class 2 surplus become more visible as Class 1 nickel as the Chinese brands have been listed on the LME. Longer term, there's probably a little bit of concern about some of the battery technology changes around nickel, but the main problem has been Indonesia's producing too much. But we're at the point though where if your ferronickel producers out there are not making money, so you're likely to see some supply adjustment in the near term. And what I would say now, the gap between Class 1 and Class 2 is barely covering conversion costs now. So feels like we're pretty much at the bottom of that mark. I can see why. I mean, it was everyone's favourite to come down in the second half of the year. That's happened. Feels like we're now in the cost curve and causing problems.
Apologies, I may misquote you, but I recall you said words to the effect that the conversation around governments potentially funding processing is a bit of an easier conversation than one for governments funding mining. Could you please elaborate on that?
Yep. Processing is technical. It's an engineering problem, and it's something you can build a factory in your jurisdiction, and you can be pretty comfortable in that. So that has jobs in your jurisdiction. So governments like that. The second thing is, honestly, mining industry has provided for the past 20 years. There's an assumption out there in governments that, look, there'll always be raw material supply because there always has been. And so therefore, it's like, well, why do we have to put, that's a particularly US view, but why do we have to put money at it? Because, and I mean, if we think at the moment, if you're an auto buyer at the current time, and you were in this conference last year, you've been hearing about problems in lithium. Lithium price was fourfold what it is now. Cobalt, nickel, copper. Arguably, there's enough of all of those at the moment. So you still think the market provides for you. But that neglects the fact that the gestation of these mining projects is so long, to get that supply reaction will take a while. So for now, there's enough material. 5 years down the line, there is not. Oh. One more question.
How about rare earths?
How about rare earths? I mean, interesting. Obviously, at the forefront of geopolitics. What's it? I mean, it's interesting. Gallium's much more China dependent than rare earths, and we did see China restrict gallium exports again as part of the wider geopolitical battle. For now, I mean, rare earths are definitely one where you're going to see governments want to alleviate the dependence on China because they are so crucial for the energy transition, and honestly, they're so talked about. Understanding of rare earths is not great. So people are more comfortable looking at something like copper. Copper is an easy story for people. Rare earths is always a little bit harder from that side. So to me, it's a bit of a special situation, but I do think it's an area you will see government backing for. Thank you very much, everyone.